We've seen multifamily pricing come down by about 25 to 30%, and you've seen single family home prices go up by 5.8% over the last year. Welcome back to another episode of Keeping It Real Estate. I'm your host, Mike Roeder, and today we have an exciting episode lined up for you. We're going to be exploring the latest trends and projections in the real estate market that you need to know about as we move forward into the latter half of 2024 and onward. So the first thing that's on everyone's minds right now are the Federal Reserve rate cuts on the horizon. So if you don't follow the Federal Reserve, they recently had a meeting, and right now there's about a 97% chance of rate cuts happening in September of 2024. So coming up here next month. And that is a big deal. They have not cut rates yet, but they're expected to next month. They've increased rates 11 times. So there's been 11 rate hikes since March of 2022. So over the last 2 years, the federal funds rate has went from 0.25% all the way up to 5.5% currently. So there's been a massive increase in interest rates, which has really created the bulk of the pain in the multifamily industry and basically all of commercial real estate, especially deals that have floating rate interest rates or short-term debt or maturing debt on the deals. So a couple more points in regards to the Fed. They have had a lot of success in steering inflation towards 2%, which is their target rate for inflation. There's a positive outlook for the economy. So far, they seem to have been able to achieve a soft landing. Now, we'll see what happens over the next couple of years. You know, the jobs report did cool down quite a bit on this last print, and there's also some skewed data in there as well. But overall, you know, it's an indication of a soft landing coming, which is great. Wage growth has been outpacing price increases for the past 15 months. So that's a great thing. That means that people have more buying power as compared to what inflation has been doing. And then the job market has really returned to pre-pandemic balance, which is a good thing. Now, let's talk a little bit about delinquency rates and market health. So overall, commercial real estate loan delinquencies are at 4.5%. Multifamily delinquencies are projected to rise from 1.3% to 1.5%. So significantly lower than the overall commercial real estate industry, which is a good thing. Office delinquencies are currently at 8.1%. I think everyone knows that there's been a lot of pain in the office sector, especially since COVID. A lot of vacancy, a lot of loans, that are, belly up because of the vacancy rates. There's also a lot of shadow inventory. So basically in the office sector, you have a lot of long-term leases. And even though a tenant has moved out and there's no one in that building, they're still paying rent. So you have a lot of those leases that are coming due relatively soon. And that's what's called shadow vacancy. So you have a lot of that in that sector. Now, office delinquency is predicted to increase to 9.9% next year. So that is still trending upwards. Looking at retail rent growth is on the uptick. So that's a huge plus, especially for triple net lease opportunities or opportunities where you're buying into retail spaces. Hotel occupancy rates are nearly back to pre-COVID levels. So that's great for that industry. And then industrial properties are still showing very low delinquency at about 0.4%. So let's dive a little bit more into the multifamily market. So first off, multifamily property prices are down by about 25% nationwide. We're seeing anywhere in between 20 to 30% in the Dallas-Fort Worth market and the Nashville market, which are the two markets that we're very active in buying in. That presents a huge buying opportunity for individuals that are able to come in with the equity and place the loan on these type of properties. Another thing, brokers are really looking for certainty of close. That is one of the most important pieces. We actually just had a property that we had bid on a few months ago, and we were about $2 to $3 million lower than the person that they chose. It fell out of contract, and now the sellers are reaching back out to us and trying to get us to bite off the deal at a much lower price. And we're hearing across the board from multiple brokers that is the number one piece when you're going to sell a deal these days, is just to select a group that's going to be able to come through and be able to perform on what they say they're going to do. So very, very important piece of the puzzle. And it allows certain buyers to put deals under contract for a much lower price because of that certainty to close. Now, another thing in the multifamily market that certain submarkets are suffering from is higher multifamily starts. So multifamily new projects that are coming online. So supply for multifamily units is at the highest level since the Nixon era. This tells a story. There's a lot of deals coming on the market, and that's affecting occupancy. It's also affecting rental rates. And you really need to pay close attention to those new units that are coming online and where you're buying, what submarket, because there's certain submarkets that are very insulated from the new supply, and then there's certain submarkets that are not. The nice thing about both markets is if you're insulated from the new supply, not a lot of worries there. If you're not insulated from the supply, sometimes you can actually get a nice discount because of the occupancy adjustments and the rent adjustments that are being seen in that submarket. So you just have to have data. You have to have knowledge surrounding that. There's also an increasing number of Americans becoming renters. So we've sent this out on multiple newsletters. There's a huge affordability gap right now. About $1,314 is the gap between home ownership and renting. That is a massive gap. It's one of the largest over the last decade or so, probably plus 10 years. And so, when someone is looking to buy a house, a lot of times there's a lot of barriers to entry. Home prices actually have hit a record high in May of 2024. Average home price is $419,300. Very high amount for most submarkets when you take a look at the average over the last couple of decades. And it's actually up 5.8% from last year. So we've seen multifamily pricing come down by about 25 to 30%. And you've seen single family home prices go up by 5.8% over the last year. So great if you've been an owner for years in the single family space, but when you're taking a look at the buying opportunities, not a lot of opportunity in the single family space because it hasn't, dropped off. You're not in a valley or, buying a smile. Whereas in the multifamily space, you've seen a big decrease in price and you're essentially buying close to the bottom of the market, in our opinion. 31% of buyers are first-time home buyers. 28% of sales in the single family space are all cash transactions. So that's showing you a lot right now. Buyers need an income of at least $115,000 to afford a typical home. And when you take a look at Dallas-Fort Worth, you take a look at Nashville, you take a look at a lot of these top markets across the country, it is very tough to find a submarket that has a median household income of $115,000. That is very high. It may sound like a reasonable number to you if you're listening to this podcast, but that is a very high amount. And that is the reason why our nation is becoming more and more so a renter nation year after year. More middle income Americans are choosing to rent, due to these rising home prices. And one other interesting statistic is townhomes are becoming a popular alternative to traditional single family homes. So another piece to tune into. So let's talk a little bit more about why now is a great time to invest in the multifamily space. So number one, anticipated rate cuts are going to make financing more favorable. We're seeing this on the daily. So just over the last week or so, interest rates, or I should say the 7, the 10, the 5-year treasury rates have plummeted quite a bit. And that essentially relates directly to the interest rates that we're able to put on these deals. So to give you a case example, we have a deal that we're looking to close on relatively soon, and we underwrote a 5.82% interest rate. If we locked our interest rate today, which we haven't locked yet, we'd be at 5.2%. So just over the last couple of months, the interest rate on the 7-year term that we're looking to do has fallen by about 62 basis points, by about 0.62%. That is a big decrease, and that's making the financing more favorable. Highly discounted prices really offer a great entry point for new investors. So sure, we're dealing with some supply issues. Rent growth has tapered off because of the new supply, but we do expect that to come roaring back over the next couple of years, especially when you take a look at industry reports like Yardi, CoStar, ALN. There's a lot of industry reports that are showing that rent growth will be coming back. And one other thing to note with the new supply that's coming online, new starts for multifamily have plummeted by at least 50%. So when you take a look 2 years out into 2026, 2027, the amount of supply coming down the pipeline is not going to be able to keep up with the demand in a lot of these submarkets that we're investing in some of the hot markets out there, which is a great thing. There's, still a strong U.S. economy. It's supporting rental demand. Another piece is single family. There's a lot of overvalued single family homes, and that's really pushing more people towards renting. And again, that affordability gap over $1,300 is pushing a lot of people into the rental space. Favorable loan terms are still available for multifamily investment. So we're actually seeing interest rates around 5.2% through the agency loans, Fannie and Freddie right now. That is overall a great rate when you look at historical numbers and when you compare it to bank loans. We just took a look at a bank loan the other day. It was at about 7.5%, whereas, going with an agency loan, we're sitting at 5.2%. So still very reasonable. We're still seeing very healthy leverage as well. So right now about 65 to 75% leverage, which is a great space to be in. We typically do not like to go above 75% because it adds a lot of risk onto the deal. Still seeing decent amount of interest only. A lot of times you're looking at 3 to 5 years of interest only, which really boosts cash on cash returns and the cash flow throughout the ownership. And, overall, just favorable lending is still available out there in this market. A couple other things that I wanted to talk about today. U-Haul's 2023 growth states. So something that we pay close attention to are U-Haul statistics. Where are people moving to and where are they moving from? So U-Haul data shows where the high growth real estate markets are if you tune into that. So if you're ever looking at buying a single family, an Airbnb, a multifamily project, a commercial project, tune into U-Haul stats. It's a great free piece of information that can tell you a lot about a submarket, a state, a city when you're taking a look at investing. So Texas and Florida were at the top list again in 2023 for people that are moving into those two states, one-way moves. The biggest winners overall were Texas, Florida, North Carolina, South Carolina, and Tennessee. Two of those states are the states that we invest in, which is Texas and Tennessee. Also great states because they have no state income tax. They're very landlord friendly. Lots of positives about those two states. The biggest losers were Massachusetts and California. So Massachusetts was number 49, California number 50. So that's states where people are moving out of, and they're moving to states like in the Sun Belt, Texas, Florida, North Carolina, South Carolina, Tennessee. So overall, multifamily market is seeing balanced growth, steady increase in multifamily rents across the nation. Again, rent growth has tapered off quite a bit, but we do expect that to come back quite substantially over the next couple of years. And overall, there's been a lot of resilience of the multifamily market amidst the broader economic fluctuations. We have been getting more and more calls from brokers where you have sellers that are looking to get out of short-term loans, or they're basically not able to cash flow the deal and they're needing to get out for a highly discounted price. So there are a lot of opportunities coming down the pipeline, and we're seeing that ramp up week after week, and we expect that to continue happening throughout the next 12 to 24 months. So that's it for today's episode. Thank you for tuning in to Keeping It Real Estate. And remember, if you want to see our upcoming investment opportunities, click the link in the description or visit granitetowersequitygroup.com/invest and join our email list. We'd also be more than happy to jump on a call with you. And you can also find the link in the description of this podcast. Filling out the form is completely non-committal and simply gives you access to information about our future investments. So thanks again for listening into this podcast. We'll see you next Tuesday on another episode of Keeping It Real Estate.